Hello, Dividend King subscribers. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Of course, one of the founding partners here, the Dividend Kings. And this is a series of articles I've been doing where I ran a screen using mega cap stocks, looking for mega cap stocks, using the Joel Greenblatt magic formula for identifying stocks that could beat the market. Now keep in mind, Joel Greenblatt's primary motivation was beating the market, and that's a good motivation. A lot of people, that's all they think about is beating the market. But as a Dividend King sponsor, I think more about producing more income than the market. I think that's a much easier task to create and a much more lofty goal. Now, having said that, I'm also going to point out here as I go through this video that currently I believe it's going to be easier to beat the market over the next 5 years than it has been over the last 10 years. And let me see if I can illustrate that for you by going to our FastGraphs tool here. So first of all, I've got the S&P 500 here. And those of you who are familiar with FastGraphs on FastGraphs recognize that this orange line is a valuation reference, and it's being drawn here at a PE ratio of 15, which is historically a normal fair valuation reference. Now, we also have the normal PE for this time frame, which is 17.55. So what I'm basically saying to you is that these are the ranges that the S&P should trade at if it was either really attractively valued, fairly valued, or at least within normal ranges. What I want you to see here is that despite the fact that we've had the COVID crisis here, which has changed the estimates for the S&P 500 for this fiscal year dramatically, they were higher than that just a few months ago. We had this original flash crash and now this enormous rally. But the point I want to make is, with a blended PE of 24.68, the S&P 500 is, in my opinion, significantly overvalued. But as I always point out, it's a market of stocks and not a stock market. And so all stocks are not overvalued, which brings me then to what I'm going to be covering in today's video. This is the magic formula selections. If you recall from the previous parts of this article, I came up with 30 stocks. I rejected 17 of them because they didn't really fit what I consider to be the criteria for Dividend King subscribers. And so, what I've done is I've whittled that down to 13 stocks, and I covered 4 in last week's video, and I'm covering the next 4, and I'm doing this in order of dividend yield highest to lowest. So this week, I'm going to be looking at Cisco, Bristol Myers, Merck, and Amgen. Now, what's interesting here is I do want you to notice that 3 of the 4 just happen to be in healthcare. Because again, not only is it a market of stock, it's also a sector of stocks. Different sectors have different valuation levels. And one of the things you'll find here is that it's very rare. Technology is actually a very highly valued sector. You got Apple, Microsoft trading at very, very high valuations. However, you got Cisco here that's actually attractive, and I'll show you that here in more detail in a moment. And then we've got the 3 healthcare stocks. 2 of them are pharmaceuticals, then of course Amgen, which is the largest biotech. These are all extremely high quality companies, AA minus rated or better. We got 1 at A minus, 1 at A plus. And I also want you to notice they all have reasonable levels of debt with the exception of Amgen. I like to see 50% or less debt, but in today's low interest rate environment, a lot of companies are borrowing more. But anyway, let's go ahead and look at each of these individual stocks now one at a time. And let me illustrate why I think they're more attractive than the overall stock market from the ability not just to outperform the market, but from the ability of being able to generate more dividend income than the overall stock market. Now, when I start with Cisco here, I'm going to shorten this time frame dramatically because what I want you to notice is Cisco did not start paying a dividend until 2011. And, from that point in time, you can see that their dividend has grown very nicely. So if I look at performance, this is a period of time when Cisco was reasonably valued. It grew at about 6.3%. It's reasonably valued, and now this is based on using the normal PE for this time frame of about 13. It's below the theoretical fair value 15 PE ratio that I often talk about, with an earnings yield of 6.66%, which says the earnings yield is 7.57, and of course the dividend yield based on yesterday's close is 3.41. It's AA minus rated with only 22% debt. I like all of those attributes. But let's compare the performance of Cisco versus the S&P 500 over this time frame. The most important aspect here is the fact that the dividend income, even though the company just started producing a dividend, has been actually greater than the S&P. Now, in this case, I also included a year where the company did not pay a dividend. So let's shorten the graph one more time. Now, a couple of things happen when I do this that I want to make sure you see clearly. One is I actually have a better starting valuation, but I'm now covering the point where Cisco is paying a dividend as the S&P has paid a dividend in every year that I'm covering. Now, when you go to this level, you see a much different picture. Cisco has generated roughly almost twice as much dividend income as the S&P, not quite, but close, over $5,000 versus $2,800. I also want to point out that the company's now in virtually a dead heat, if you will, from a standpoint of performance. And these are very, very good years for the market, notwithstanding the fact I do want to remind you that the market itself is actually dramatically overvalued at this point in time. But if I go back and measure this apples to apples, and so if I go ahead and look at the time frame where, I'm running a 12-year graph on Cisco, I'm going to go ahead and shorten this now to a 12-year graph on the S&P. We had the S&P attractively valued. Cisco was a little better valued. That's part of why we've got this what I call dead heat. But we're also measuring the S&P overvalued, where Cisco is now undervalued. So the contrasts here are important. Valuation matters, and it matters a lot. Now, having said that, if Cisco were to trade at this normal PE going forward, it would generate a 7% annualized rate of return, whereas I showed you earlier, and I showed you in the written portion, and I'll go ahead and show it again. If I did the same type of analysis for the S&P, and I'm being more generous here, we'd actually have a negative annualized rate of return, a negative loss of about 8.7%. in terms of growth, total negative loss of -4 when you factor in dividends. The point is, this is not an optimum time to be investing in the S&P. I do believe it's an optimum time to be investing in Cisco. And so the point is, beating the market on both a total return basis as well as a dividend income basis, I believe is going to be much easier in the next 4 or 5 years for the reasons I've suggested here than it has been, historically. Now I'm going to move on to Bristol Myers. I wrote a full article on this stock. I consider this an extremely attractively valued pharmaceutical right now. And if you really look at this graph closely, I've got the full graph here. The company went through a period of very flat growth for several years, from 2002. Actually, if you go all the way back to 2001, where it had negative growth, it was really very poor operating results. But since 2015, if you look at the graph here from that point in time, and let me see if I can hit it perfectly, I'm pretty close. Now all of a sudden we've got a 21.68% growth, and we've got a stock trading at 10 times earnings with a yield of 2.88%. It's A+ rated, and it has less than 50% debt, which, as I mentioned, I like. But the real key here is, if I look at performance potential, I've got annualized rates of return of over 45% if the earnings come out as expected here, and if the company just returns to a normal PE of 18. And of course, if it used the P equals growth rate formula, the numbers would be even better. But going back to this, if we run this again as a 12-year graph, kind of like we did with Cisco, and measure performance from a standpoint of total performance, we get growth underperforming the S&P. And again, that has to do with the fact that the S&P is currently overvalued, as I mentioned earlier. But once again, we get significantly more dividend income than we saw with the S&P 500. We have a much better valuation. I consider much lower risk level here looking at Bristol Myers than we do looking at the S&P 500 today. So let's move on. Now, Merck is a very, very similar story to what you saw with Bristol Myers. One thing that happened after the early 2000s is that these pharmaceuticals really hit a flat period. There were even discussion that all of the chemically based pharmaceuticals had been discovered, and that didn't turn out to be totally true. In a way it did, because these companies have moved into biotech just like Amgen, etc. But I do want you to notice, just like we saw with Bristol Myers, although not to the same extent, we have seen an acceleration of growth here in recent years. So once again, if I go back to that 12-year period of time to kind of keep this level, we got Merck coming in dramatically undervalued compared to the S&P that was, at least fully valued. But we end up with significantly more dividend income investing in Merck since 2011 than we did the S&P. And we've got a pretty comparable growth period. The S&P outperformed slightly. And of course, on the total return, the S&P did outperform a little bit. But the point is, if you're looking for dividend income and dividend growth, Merck would have been the better selection over that time frame. So those are, your two major pharmaceutical companies. And I'll close this video by finally looking at Amgen. Now, there's a couple of things I want to say about Amgen. as I go through this. This stock is one that I'm currently long in, so I want to issue that for disclosure. But I've owned this stock for actually several years, or I bought it somewhere in here when it was reasonably valued. I do consider it fully valued today. The blended PE of 16, an earnings yield of 6.1. I like an earnings yield of 6.5. The stock is down a little bit today. Just want to make the point that I would be wanting to buy this if I was going to add new money at a slightly lower valuation. But let's go ahead and run that 12-year kind of comparison to the S&P that I've done with the other three and look at performance. Now, once again, I'm going to be covering the entire time that Amgen paid a dividend, but I'm also dishing them by having 1 year here where they didn't pay a dividend. So if I compare even that level, Amgen still outproduced the S&P 500 on total income. And interestingly enough, because this is one of the more growthy stocks of the four that I've shown here today, it outperformed the S&P on a growth potential and also then on a total return. So it's been an outperformer all along, but a lot of that has to do with the fact that it was undervalued versus fairly valued, and it's only slightly overvalued today, where the S&P is actually, in my view, dramatically overvalued. So, valuation matters, and it matters a lot. Now, these are all the kinds of dividend growth stocks that I, like to see. Amgen has grown their dividend at a very high rate, but you have to call out a couple of these numbers here. So if I shorten it just to the last, what I'll call more reasonable years, we still see over 20% growth. But notice the dividend growth rates have slowed down some. And of course, with the valuation being a little pricey here, I would consider this the least attractive of the group I've shown you. I do consider it one of the better companies in the group I showed you. The only thing I'm really objecting to is valuation. Anyway, I hope you got something out of this video. I'm Mr. Valuation. Valuation matters. I think one of the big advantages we have with this particular set of companies that I've shown in this article is we've got much better valuation than the market, and frankly, better growth with most of these stocks than we see in the market. So beating the market over the next 4 or 5 years should be a lot easier than it has been, not just on an income basis, which I think these stocks will continue to outperform more dividend income, which is a very, I think, reasonable goal and relatively easy goal to accomplish. But more importantly, they're actually poised to outproduce it on a total return. Anyway, that's my take based on valuation and assuming that nothing changes. If you like this video, give me a like, hit the bell if you want to see future videos like that on my YouTube channel, in addition to this Dividend Kings offering we offer here. I want to thank you all for watching, and everyone have a safe and healthy and prosperous year going forward here, and let's have a good weekend. Thanks for watching. This has been Chuck Carnevale. I'll talk to you next week.